Welcome back to the deep dive. Today we're tackling something pretty fundamental. We're looking at sources that really dig into the fragility baked into our current financial system, and importantly, what it actually means to try and build an alternative, something based on Bitcoin and sovereignty.
It's a fascinating area, and the sources really lay out this core conflict, this tension.
Yeah, exactly. On one hand, you've got this powerful idea. Just opt out. Full self-custody. Take back control. Simple, clean.
Right, the sovereign individual path.
But then there's the messy reality.
Right.
We still have to, interact with the existing world, pay bills, pay taxes. So we need some kind of bridge, some interface with that fiat system.
We can't just wish it away. And the central voice in our material today, Caitlin Long, she's perfectly positioned to talk about this.
She really is.
Yeah.
A Bitcoiner since way back 2012, but also spent years deep inside Wall Street.
Exactly. So she brings that dual perspective. And her analysis really focuses on, I'd say, three key things. The danger of leverage, that's huge. Then the need for smart regulation. And finally, what hyper-Bitcoinization might actually look like. And spoiler, it's probably not the explosion some people expect.
Okay, let's start with that first point, the appeal of opting out. Why is the traditional system seen as so inherently flawed? Our sources are quite detailed on this.
They really break it down. It comes down to leverage and counterparty risk. It's just fundamental to how banks and even broker-dealers work.
And not just banks, right? It goes deeper.
Oh, yeah, the whole setup, even when you think you own something, like stocks in a brokerage account.
Right. This was a real eye-opener for me in the material. You don't legally own the shares themselves.
Nope. What you own is, and this is the source's phrasing, IOUs to somebody who has the legal title.
An IOU. So you're relying on that broker, that middleman.
Precisely. You're dependent on their financial health. If they go under, well, you're basically just another creditor lining up hoping to get something back. Your ownership isn't direct, it's conditional.
Yeah, that's the counterparty risk right there. It's the default setting in traditional finance.
It is. And the tragedy, or maybe the predictability of it, is that we saw this exact same structure, this same temptation replicate itself in crypto.
When it was unregulated, yeah.
Yeah.
The same human flaws just reappeared.
Absolutely. Greed, cutting corners. Look at the examples. FTX, that was outright fraud plus being fractional. Celsius, Alex Mashinsky promising things that weren't sustainable. BlockFi with its lending pools.
What's the common thread?
Leverage. Out-of-control leverage using customer money. Making promises you can't possibly keep if everyone asks for their money back. It's why the source has that sharp warning. A fool and their leveraged Bitcoin are soon parted.
Okay, that really sets up this next point, which I found incredibly useful. The difference between good borrowing and bad borrowing. Commodity credit versus circulation credit. Can you unpack that?
Yes, this is fundamental. It's the key to understanding financial stability, really. So, commodity credit, that's the good kind.
Okay.
It's considered fine, non-inflationary. It basically means borrowing up to 1-to-1 against real existing savings or assets.
Like putting up collateral you actually have.
Exactly. So imagine you own Bitcoin that's gone up in value. You borrow dollars against that existing value, maybe for liquidity, maybe for some tax reason, like waiting on potential legislation. You're not creating money out of thin air. You're just accessing the value you already built up.
Got it. Dollar for dollar against real stuff.
Right.
So what makes circulation credit the dangerous one?
Circulation credit is when you cross that line, when you go beyond 1-to-1 leverage. This is credit created effectively from nothing, not backed by prior savings.
So like fractional reserve banking, but maybe even more broadly.
Precisely. It could be a bank creating loans based on a fraction of deposits, or, a crypto platform lending out more Bitcoin than it actually holds. It's manufacturing promises.
So if I lend $100, take the promise of repayment, and then lend that promise out again, I've just doubled the perceived money supply.
You've got it. That second $100 is circulation credit. It's inherently inflationary, inherently unstable. And the source is very clear. When credit creation goes beyond that 1-to-1 based on real savings, literally it's not going to end well. It's a mathematical problem waiting to happen.
It really reframes things like the FTX collapse. It wasn't just fraud. It was built on this fundamentally unstable type of credit.
Yes, the structure itself was doomed.
Okay, but given how unstable that old system seems, why not just let it crash? There's a strong sentiment, especially in sovereign circles, saying, let's just build the new thing and let the old one fail. Why do the sources argue for a slower transition? A whimper, not a bang.
It comes down to pragmatism, really, and maybe a dose of historical perspective. The reality check is, well, almost everything still runs on fiat.
Like paying your employees or your suppliers.
Exactly, paying your taxes. You mentioned the IRS earlier. Try paying them in sats right now. The plumbing for a total overnight switch just isn't there for the vast majority of people and businesses.
So a practical constraint for now.
It is. But there's also a deeper reason, a kind of ethical or historical reason cited in the material. The hope for a whimper is about avoiding catastrophic social disruption.
Okay.
Yeah, there's this really potent personal story. The speaker's father was born literally days after Black Monday in 1929, grew up as a Depression baby. Scarcity, rationing, that was his childhood.
Wow. Okay, so this isn't just abstract economics for them.
Not at all. It's lived experience, or at least one generation removed. It's about avoiding that kind of widespread suffering.
And there was another story from that time about the grandfather.
Yes, during the Roaring Twenties, that period of massive speculation, apparently his neighbors were all borrowing heavily against their farms, leveraging up to buy stocks. They got completely wiped out in the crash, lost everything.
But the grandfather didn't.
No. He refused to leverage the farm. He prioritized stability, that slow and steady approach. He kept his family's generational wealth intact, while others around him lost theirs. That lesson, the danger of leverage, the danger of speculative mania, is why a gradual transition is preferred. A bang hurts real people, potentially for generations.
That makes a lot of sense,
Yeah.
avoiding that kind of generational setback.
Yeah.
Which logically leads us to, well, if we can't just exit cleanly, we have to engage. We need to build that bridge carefully. And that seems to be the origin story of Custodia Bank. It started small, right? In Wyoming.
It did. Very specific initial goal back in 2017. Wyoming had this problematic money transmitter law that had actually driven big players like Coinbase and Circle out of the state a couple of years earlier.
So the first step was just fixing that law.
Yep. Just get that fixed so companies could operate there again. And they did. It passed unanimously. Quite a feat.
But then it snowballed into something much bigger.
It did, because it tapped into a deeper issue the legislators really understood. The debanking problem.
Ah, okay. How so?
Well, Wyoming had actually been targeted years before by something called Operation Choke Point, which went after, among others, the firearms industry. So the state's politicians already had this visceral understanding of what it felt like for the federal government or big banks to cut off financial access to perfectly legal businesses they didn't like.
So when crypto and this idea of sovereign banking came along,
They immediately saw the connection. They saw it as a tool for individuals and maybe even the state to, as the source says, take their sovereignty back. They didn't need to be crypto experts. They understood the principle of financial self-determination.
that's fascinating, and it led to a lot more legislation.
Oh yeah, it exploded. Wyoming's enacted something like over 50 laws to enable crypto and blockchain since 2018. But beyond the number of laws, there are a couple of anecdotes that really show the shift in mindset.
Like,
First, at the legislative meet and greets for these new laws, suddenly there were all these new faces. Younger people getting involved in state politics, which was unusual. Though, interestingly, the source also mentions a grandmother mining Bitcoin in her garage because her granddaughter got her into it. So, and we're a real mix.
a sign of new energy, new engagement.
Definitely. And the second thing was about talent flow. Historically, Wyoming's best and brightest, they'd leave for Denver or New York for opportunities.
The classic brain drain problem.
Exactly. But suddenly, legislators were noticing people coming up from Denver to Wyoming, specifically for crypto and blockchain events. The flow was reversing. That was a powerful signal that they were onto something economically important.
That creating regulatory clarity could actually attract talent and business, not repel it.
Precisely. It showed regulation could be a feature, not a bug, if done right.
Okay, so let's project forward. Imagine this path continues, this careful integration. What does the world look like in, say, 2 or 3 decades for the average person dealing with money? The sources suggest self-custody becomes normal.
Yeah, the prediction is it'll be second nature, like using a password manager or a secure web browsing today. Just normal, easy user experience.
In traditional banks. Still around.
Oh, probably. People will still need mortgages, payment services, things like that. Banks will likely exist as service providers. But the crucial difference, the sources argue, is that you won't be forced to keep your core savings, your wealth, inside that leveraged, counterparty risk-heavy system.
You'll have the option to hold your primary assets yourself. Sovereignty becomes the default choice, not the difficult exception.
That's the idea, optionality and control over your core wealth.
So looking at the present, what's the trend happening now that makes the source most optimistic, most bullish about this future actually happening?
It's the emergence of what are being called Bitcoin treasury companies.
Okay. What are those exactly?
Think of companies that are deciding to hold significant amounts of Bitcoin on their balance sheet as their primary reserve asset. The source even calls them, quite dramatically, speculative attacks on the US dollar.
Wow. But there's a crucial rule for how they operate, right? Related to that credit distinction we talked about.
Absolutely critical. They must borrow in dollars, in fiat currency, to fund their operations. They cannot borrow in Bitcoin.
Why is that distinction so vital?
It prevents them from creating the very problem they're trying to solve. If they borrowed in Bitcoin, they could potentially start lending out more Bitcoin than they have, creating that unstable circulation credit, that fractional reserve Bitcoin. That's what blew up FTX and the others.
So by borrowing in dollars, they use fiat debt, but keep the Bitcoin side clean, one-to-one. If they run into trouble, the failure happens in the dollar system, not by corrupting the Bitcoin supply itself.
Exactly. It keeps the core assets sound. It's a structural safeguard against repeating the mistakes of the past.
And tied into this strategy is something that sounds technical, but seems hugely important: the Bitcoin yield curve. Why is developing that such a big deal?
It's massive, especially for anyone coming from traditional finance. Michael Saylor's work is highlighted here. A yield curve, or a forward curve, essentially maps out the cost of borrowing money over different periods of time, short-term, long-term.
Like, it tells you the interest rate for a 3-month loan versus a 10-year loan.
Precisely. Having a functioning yield curve allows sophisticated financial players, corporations, institutions to price risk, to hedge, to plan long-term investments. It's fundamental for mature capital markets.
So the fact that a Bitcoin yield curve can be constructed,
It signals that Bitcoin is moving beyond just being, digital gold or a speculative asset. It's starting to show the characteristics of proper foundational collateral, something you can build an entire complex Bitcoin capital market on top of. You can't really do serious corporate finance without a yield curve.
it provides the financial grammar needed for institutions to engage seriously.
That's a good way to put it. Now, the irony pointed out in the sources is quite stark. While the big regulated Wall Street firms were kind of held back, maybe by cautious regulators, the people who came from Wall Street, the really smart quants and traders,
Like Sam Bankman-Fried, who came from Jane Street.
exactly like him, they went out and built their own unregulated, highly leveraged versions of these crypto capital markets. And, well, they blew themselves up, as the source puts it.
Proving the point again about leverage and the need for either strict rules or incredible discipline.
Yes, human nature seems to find a way to leverage things to the breaking point without guardrails. Vigilance is key.
Okay, so let's wrap this up for the listener. The main takeaway seems to be that achieving real financial sovereignty isn't just one thing. It's not just self-custody.
No, it's a dual approach. It requires your own action, yes, taking responsibility for your keys, understanding self-custody, but it also requires strategic engagement with the world as it is, pushing for clear, sensible regulation that allows sound structures, like custodia, to emerge and provide those necessary bridges.
It's definitely a marathon, not a sprint.
Absolutely. And that brings us back to that historical echo. Remember the grandfather from the 1920s?
Yeah, the one who didn't leverage his farm.
Right. He apparently scoffed at people with their paper wealth, their leveraged stock positions. He held on to his real generational asset, the farm, through discipline.
A contrast to today, potentially.
Well, that's the final thought we want to leave you with. Bitcoin is arguably this unprecedented, hard cap, potentially generational asset, the ultimate sound money. So the question to ponder is this: if leverage, that siren song of easy games, is the fundamental flaw, the Achilles heel of the legacy system we're trying to move away from, how disciplined do you need to be? How disciplined do we need to be collectively to ensure Bitcoin actually secures generational wealth, rather than just becoming another chip in the same old speculative casino?
Something to definitely think about as you navigate your own financial journey. Thanks for joining us on the Deep Dive.